Hi, everyone. Welcome back to the Weekend Charts, where I run through the most important charts and themes in markets and investing. Another big show for you this week. A lot to talk about. I want to start out with the inflation reports that we've received, and all the signs seem to point to the fact that inflation in the US is slowing fast. So let's run through some of these charts right here. Starting with CPI, and CPI number 6.5%, another move lower. We're now down a number of months in a row and well off the peak of 9.1% last June. So that was the highest number for US inflation that we saw since the early 1980s. And importantly, here, it's not just the overall CPI that's moving lower. We're seeing core prices move down as well, 5.7% increase off of that peak of 6.7%. So good sign there. We also have producer prices in the US, 6.2% increase. That's the lowest we've seen since March 2021. So you got to go back some time. And that's well off the peak that we saw in March 2022 of 11.7%. But if we look at these two reports, we look at CPI up 6.5%, we look at PPI up 6.2%, doesn't tell the true story in terms of how fast inflation seems to be slowing. We got to look at the shorter term, look at the last 6 months where CPI is only up 0.2% and PPI is actually down. And over the last 2 months, both consumer prices and producer prices showing declines. So big shift from where we were a year ago, where all of these things were showing an acceleration in inflation. Now we're seeing a deceleration across the board, particularly the last few months. And what's driving these lower inflation rates? If we look at where inflation is today versus last June, we're seeing a number of components driving it. It's not just one thing that's pushing it lower. Used cars now are down year over year versus a 7% increase last June. Gas prices down year over year versus almost 60% increase last June. So pretty much many of the major categories showing declines: fuel oil, gas, utilities, many things showing decline. The one area that's still showing an increase, that's a very important one, would be shelter. And so shelter, single biggest component of CPI. People simply spend more money on housing on average than anything else in their budget. It's over a third of the CPI index. So that's still moving higher here, 7.5% in the December number. That was the highest we've seen since the early 1980s. So we'll talk about in a little bit why shelter is still moving higher, even though actual housing inflation seems to be now moving lower. But zeroing in here on utilities is a big one for many people. Obviously, winter months, heating bills, gas, utilities still very high. 19% year over year increase in December. I think we're going to see a moderation in January, and perhaps a significant one based on the prices of natural gas futures just really collapsing here. So this is something that nobody was suggesting would happen last August when natural gas futures peaked. But now we're down 69% from that peak, lowest level since mid 2021. So great sign there for consumers seeing the collapse in natural gas prices. But getting back to that shelter component and the housing inflation, what we have here is something very interesting where we're seeing the actual rents. So if we're looking at a national average of US rents, they're actually going down over the past a few months. 3 months in a row, rents have gone down in the US, and the year over year rate of increase is decelerating at a rapid pace, now up only 4% year over year. So the question is, why is this still showing an increase in the shelter component of CPI, where we're showing an increase in that year over year rate of change when clearly actual housing inflation is going down? Well, it's simply the way shelter CPI is calculated causes a lag in terms of the relationship with actual prices. So as the months go on, that lag is going to reflect itself, perhaps with a few more increases in shelter CPI, but at a certain point, you're going to see this roll over as well. And if we look at the bigger picture of where shelter CPI is versus actual rents since the start of 2020, you can see here we just had this huge surge in rents in 2021. and in early 2022 before it started moving in the other direction. And shelter CPI simply was understating, underreporting that inflation. And this is just showing you rents. Home prices even showed a bigger increase, over 40% in a 2-year period. And shelter CPI, the way it's calculated, simply wasn't reflecting that. And now it's closing some of that gap, at least with rents, but it's doing so on a lagged basis. So while rental inflation is coming down, shelter CPI still moving to play catch up. So in the coming months, you're going to see probably shelter CPI begin to slow at some point, and then when it turns, when it starts going in the opposite direction, assuming that rents and home prices continue to come down, then we're going to see that a huge impact on CPI, just given the weight of shelter in that index. So all these signs pointing to lower inflation. If we're looking at the Manheim used car index, used car prices just surged in 2020 and 2021 like we've never seen before. It was a leading indicator of higher inflation, and now it continues to be a leading indicator of what I believe to be lower inflation rates to come. This 14.9% year-over-year decline in December is the largest we've ever seen. And so this suggests that we're going to see continued negative factor here for used cars in that CPI report. And what's changed here is something pretty dramatic in terms of the used car market. I thought this was crazy that this was going on last year. It was a bubble, in my view, like we hadn't seen before in this market, where people were actually flipping their cars because the prices were going up so much, where you could buy a car and sell it at a higher price. Typically, historically, for all of history, you would buy a car, and the minute you drove it off the lot, it would be worth less. That was kind of the joke about depreciation in terms of cars and how rapid it was. But demand and supply were so out of whack last year and the year before that you had prices rising for used vehicles instead of the usual depreciation. But as you might have guessed, this game didn't go on for very long, and anybody who entered this game at the end of it, which was really last July when prices peaked, is feeling some pain today because prices have started to revert back to the mean. So this is a chart showing you the average price of a used Tesla, and you can see rapid deceleration, and that deceleration has really increased over the past few months. Where now the average price of a used Tesla is down 17,000 from its peak, about 25% decline. So pretty significant in a very short period of time. Needless to say, you can't flip a car when it's moving down in price. So that game has ended. And what's just stunning here is Car Gurus has this index where they show prices every day, and we're seeing not only overall used car prices come down every day, but Tesla prices moving down much more rapidly than the overall index for used cars. So we're seeing significant price declines every single day. There's a number of factors driving that, but really supply and demand. And now there's more supply of Tesla cars. There's less demand because we have higher interest rates, and Elon Musk has talked about that, how that impacts, of course, car buying. Most new car purchases, over 80%, are financed. So when you bump up the interest rate on that the way it's been in the last year, that's going to increase. That's going to start to hit demand in a major way, and it has. And another factor is that Tesla themselves, perhaps they haven't said why, but probably in a reflection of lower demand, they're cutting prices on new cars. The report is around 20%. So if you're cutting new car prices by 20%, used car prices have to reflect that. And I don't think we're quite there yet, but pretty rapidly, this used car market is kind of repricing to that new reality. So it would be an interesting thing to watch in the coming months to see how far, how much of those used car gains are given back on this move lower. Because remember, it was just a stunning increase in the prices of used cars, over 40% in a short period of time. Now they've come down, and Tesla way more than the average, but most used cars are still way up from where they were a few years ago. And so we'll see if this trend continues here. Another factor pointed to lower inflation rates is this freight index that I like to look at from Freightos. Global containers, the prices on shipping rates for them down 78% year over year. So big difference in the picture from where we were a year ago to today. Supply chain issues are easing, continue to ease. That's good news. This is going to be reflected, I suspect, in the prices of goods, and it already has, and it likely will continue to be. Another factor is food prices, and this is the one thing in the CPI that's kind of still elevated, alarmingly so. And hopefully, this is a sign that food prices are on their way down. This is a fertilizer index. Fertilizer, major input to food costs, tend to be highly correlated with food prices over time. And what we're seeing here is a collapse in this fertilizer index, down 50% now off of its peak. So, great sign there. Hopefully, that continues. And these are all indicators of actual prices of things. But if we look at what the market's expectations for inflation are, that it's showing a similar move lower. And this is important because the Fed looks at this market. It drives a lot of relationships in markets. Looking at the break-even inflation rate, which is essentially just taking the spread between TIPS, Treasury inflation protected securities, and nominal treasuries, and you have this implied embedded inflation rate over the next 10 years. And that's at its lowest level since February 2021. And so different direction, right? So we're moving up for all this period of time, peaks last year, and now we're moving lower. The expectation from the market, at least, is that inflation over the next 10 years, not at this point, not going to be a problem. So remember, Fed's inflation target is around 2%. So if the market is correct in this assumption, which they may or may not be, but this is what they're currently expecting, not far off from that 2% level. If we look where the US is versus the rest of the world, the inflation picture in the US is improving faster than many countries. So we were down here in terms of where the US was a year ago. And now we're moving up in terms of the relative position in terms of inflation. But very importantly here, we have more green on the right side, this right column here, where many countries are now showing lower inflation rates, a trend that hopefully will continue. So this is going to be a big factor in terms of central bank policy, where if we looked a year ago, this was almost all red, with almost all countries seeing higher rates of inflation every single month. And that drove pretty much a broad-based tightening across the central bank's landscape. Well, if we look at today, if we look at countries like Brazil, inflation below 6%, they have a central bank rate well over 10%. So you have the situation where many of these emerging economies that hiked rates early on are perhaps now in a position to pause, which Brazil seems to be at that position. And then the next step would be, will they start loosening policy and cutting rates? So a factor that was a headwind for many of these markets could become a tailwind. Maybe we're not there yet, but it seems to be moving in that direction. But the big question seems to be, why is the Fed still hiking rates if we have all of these charts showing inflation is moving lower? Can't the Fed see these charts? Don't they understand that inflation is coming down? And why do they need to keep hiking rates? And many people are suggesting this is a policy mistake, or the potential to be a policy rate, that they're pushing rates up so much so fast. And this is what the market's saying, that the Fed is not done, that 1 month Treasury bills already pricing in that rate hike at the February 1st meeting. So the expectation now is Fed's not going to do a 50 or 75 basis point hike, but they're still going to hike 25 basis points at that meeting. And the 1 month, as a result, is at its highest since August 2007. And so why is the Fed still hiking rates if we have all of this evidence that inflation is moving lower? Well, this is the chart I keep pointing to. It's a relationship between wages and inflation, and it's still in an area that the Fed does not want to see. So you have 21 consecutive months of negative real wage growth, and that's by far the longest we've seen ever. And you just have loss in prosperity when you're down in this area because you have inflation outpacing people's wages, and that's leading to a loss in purchasing power. So the Fed's talked about this a number of times. They haven't talked about this chart in particular, but this is what I believe that they're looking at and saying we don't want to take the chance that inflation is going to pause or move back up. We want to kill it and bring it down, and hopefully it will stay down. And so I think as this gets closer to zero, which it likely will in the coming months, the Fed is going to be much more comfortable pausing or being less hawkish in their rhetoric. And they have the ability to do more hikes because of this chart right here. So Fed has two mandates: price stability, maximum employment. And you can't get much closer to maximum employment if you're looking at the U.S. employment rate than 3.5%. That's back to pre-pandemic levels, where we were in Feb 2020, which was tied for the lowest rate we've seen since 1969. So if you have these two mandates and one looks pretty good and one's still pretty high at 6.5% inflation, you're going to still be more concerned about inflation than employment. And I suspect at some point this year, that balance is going to shift. And then you'll start to hear the Fed talk more about pausing, easing policy in the future if the unemployment rate is starting to move up and we're seeing evidence this is starting to hit the labor market. But for now, status quo continues, just at a slower pace. Fed is expected to hike 25 basis points. And all of those people saying this is a policy mistake, where were they is my question when the Fed was increasing the money supply by 40% in a 2-year period, when they were expanding their balance sheet by trillions of dollars, when they were keeping rates at 0%, despite all of the evidence of rising prices, when they were buying mortgage bonds month after month, when home prices were exploding in a second housing bubble. Where were those people talking about a policy mistake back then? So today, the Fed is just, in my view, doing their job, which is to try to maintain price stability. And as we'll talk about, the result of that may be economic weakness, but still, that's the Fed's job. We might see a recession, but bringing down inflation is so important that you can and you probably should risk a recession, because any country that has had elevated rates of inflation over a period of time, not a good situation to be in. So the idea that you can have, let's just focus on growth and we'll try to get growth to go higher than prices, it doesn't work that way. You have to have stable prices. You have to have sound money to have a prosperous long-term economy. So Fed is going to continue. And if we look at their balance sheet, what they've done so far is really nothing compared to the increases. So they increased their balance sheet by over 4 trillion. And now we're down almost 500 billion off of the peak last April. Well, that's not enough for the Fed to stop. And so that's at 95 billion a month. If they continue that this year, you're looking at another 10% or more off of that balance sheet this year, which is significant. But in hindsight, in retrospect, here, it's not at odds with what they've done historically. We have 2 periods here where the Fed's reduced its balance sheet by what would be similar percentage decreases if they continue at their current pace this year. So still very elevated balance sheet. I think the Fed will feel comfortable continue to rolling that off as long as the employment picture stays where it is. And inflation is just the bigger concern right now still, until we get that wage growth higher than the inflation rate, which is what the Fed wants to see, what we all should want to see. So will those rate hikes, though, lead to a recession? That's the big question. And if it does lead to a recession, of course, when will it come and how deep will it be? And none of those things are answerable right now. But based on history, the idea that you can hike rates and avoid a recession, have a so-called soft landing, doesn't seem to be a high probability bet. If we look at the recessions in 1970, 73, 75, 80, the double dip recessions in the 1980s, 1980, 81, 82, early 1990s, and the financial crisis, every time CPI was above 5%, the Fed wanted to bring it down. It did come down, but the consequence of that was a recession, and there's a sound reason for that. By hiking rates, you you curb demand. When you bring down demand, that tends to lead to slower economic growth, which often pushes the economy into a recession. So the Fed wants demand to come down. They don't particularly want a recession, but they're willing to risk a recession by getting this inflation rate down back below 5%. And the Fed, of course, target is 2%. So it's been a consequence in the past when inflation rises above a certain level, you have to risk a recession. The alternative is to just allow persistently high inflation. And that's not a good situation, as I've said, for anybody. So hopefully, if the recession comes, it'll be a mild one. Nobody can predict that in advance. Is it possible we somehow avoid a recession altogether? Yes, it's possible. But based on history, yeah, that doesn't seem likely. Another indicator pointing to possible recession here would be the U.S. yield curve, which is an omen that has preceded the last 8 recessions in the U.S. And here we have the tens minus 3 month spread at its most inverted level since 1980. So 3 month yield, 1.32% above the 10-year yield. That's crazy. That doesn't seem likely to persist too much longer. Reason why we have this situation going on is you have the 3 month rising, it's tied to Fed policy. And you have the 10-year moving down and the expectation that inflation is going to come down, looking at that market based inflation expectation. And that growth is going to come down. And so historically, when you've had this situation where the short end of the curve is above the long end, there's a lag between the two, but a recession comes at some point in the future. And so, indeed, the last 8 recessions in the U.S. were all preceded by this inversion in the U.S. yield curve. And what we're seeing here today, why that 10-year yield is lower than the 3 month, are investors are bidding up that 10-year yield on the expectation that the Fed will cut interest rates in the near future. And this chart really tells the story. It's a chart of the projected path of the Fed funds rate. This is market based, so looking at Fed funds futures. What are market participants saying? They're saying the Fed's going to hike 2 more times, so February 1st, then again in March, and then that's it. They pause for a period of time, but in November of this year, they're going to start cutting rates. They're going to bring them all the way back down to 3% by the end of 2024. Now, take this with a grain of salt because this is very often wrong in terms of its predictive ability, but it's telling you the story of what the market believes today. And that story is that there's going to be lower inflation, there's going to be economic weakness, you can call it a recession or not, and that's going to cause the Fed to start cutting rates at the near the end of this year, which in terms of where where inflation is today versus historically bringing rates down to 3%, that's not very high. So like if the inflation picture is solved by not even getting to 5%, we were above 5% in 2006 and 2007, right? In that cycle with a very low rate of inflation, we were above 5% in 2000 during at the peak of the dot-com bubble. So if the Fed can somehow hike rates to less than 5% and solve what was the worst inflation crisis since the early 1980s, that would be a pretty miraculous thing. So it remains to be seen. Inflation definitely coming down. Hopefully it stays down. But I guess when it comes down, the question would be, will there be another spike higher? And will that then change the picture of this curve? So this curve is assuming that I think that doesn't happen, and that the Fed starts to be more worried about the economy than they are about rising prices. So what's another indicator in terms of a downturn in the economy? It would be the housing market, very important one. Historically, huge leading indicator. If you look at any number of housing indicators, housing starts, building permits, they tend to peak before the start of recessions, start to turn down, and then there's a recession sometime later. So they peaked in late 2021 this time around, and now we've just seen a collapse, down 30% year over year for building permits, 31-month low. So what's driving this? Just lack of demand, higher interest rates. We have existing home sales really collapsing here, down almost every single month last year, and lowest rates of home sale activity, with the exception of May 2020 during the pandemic. You got to go all the way back to November 2010. So the home buyers pulling back. They're not buying that home at the current price because it's just not affordable. Mortgage rates have gone up too much. Home prices have gone up too much, and so with a lag, you're seeing prices start to fall to reflect that lower demand. So if you want to sell your home, you're going to have to reprice it at a lower rate to incentivize buyers to come in. Thus far, we've seen 11% decline off of the June peak from last year. If we compare that to the last housing bubble, we saw prices cut by a third, and it took a number of years to get there to the bottom. Nobody knows how much or how deep or how long it's going to continue for, but as long as affordability remains a huge factor, it's hard to believe that home prices won't see further declines here. If we look at this picture in terms of what you need in terms of your percentage of your income to afford that median housing payment, just exceptionally high, 46%, just way too high. You're not going to get a loan, obviously, at that level of your income from any lender. And therefore, anyone who needs to finance the purchase of a home is going to have a hard time doing it. And therefore, prices have to come down or mortgage rates have to come down. And both of those situations are going on. So affordability is starting to improve. It's just not enough. So we've seen the 30-year fixed mortgage rate down to 6.15% off of its peak over 7%. That's good news. It's just not enough to change that affordability picture, as I tweeted out here. The combination of an increase in home prices over the last 2 years, and an increase in the mortgage rate from 2.77% 2 years ago to 6.15%. That combination has led to an 80% increase in the monthly payment, and you need a bigger down payment as well. So that's a huge factor. It's going to be weighing on the housing market, unless interest rates were miraculously to come back down to 3%. You're going to have a problem in terms of demand, just not being there, right? And at a certain point, a seller might take its house off the market, but at a certain point, people need to sell. They're moving, changing jobs, any number of reasons. When they sell, that price is going to sell not at the price they want it to sell at, but at what the market clearing price is. So if supply and demand play out here, you're likely to see lower prices in the future. So if we talk about another slowdown outside of the housing market, we have the technology market continuing to slow. Netflix, first company to report. We got a whole bunch more this week, so we'll cover that next week. But Netflix revenues up a little under 2% year over year. That's the slowest growth rate in the company's history. So you can see this rapid deceleration of growth. This is around the pandemic here. You're seeing 30% growth rates, just a huge surge in demand, people staying at home, subscribers jumping. Netflix is not alone. All of tech had a great boost in growth, and now we're seeing the other side of that, just a rapid slowdown. If we look at Netflix subscribers, 22% increase in 2020, 9% in 2021, just 4% last year. Actually had a few quarters where subscribers declined. So that's the news. But of course, prices move first. Netflix stock was down over 60% from its peak, so it's reflected obviously a lot of that weakness already. And Netflix stock actually rallied on the earnings. So it's not the news that matters, it's the reaction to the news. And so the question is, how much more will it slow from here? And what, a year from now, will it be the revenue start increasing again? And a big factor for many of these tech companies is in terms of profitability, are they going to be able to cut costs to help improve that? And you're seeing now significant cost reductions across the board, starting with labor costs. All of the big tech companies have announced layoffs in the past few months, and just recently we have big ones from Microsoft, Google, Amazon, Spotify. So across the board, companies are cutting costs. It's a reflection of the fact that they many of them overhired on the way up. So if you're gonna be expecting 30-40% increases in revenue in 2020 or 2021, which was what the market was kind of pricing in at the time with these stocks at just ridiculous valuations. Well, when you have the reality that you're not at that level anymore, Netflix is just one example, but we're seeing that across almost every company in the space. You have to reduce headcount to account for that. So, in many cases, just a right sizing. They overhired on the way up, and now they're getting back to more normal levels. So, very different picture as we talked about in the tech sector versus the overall U.S. economy. Overall U.S. economy, if we look at the unemployment rate, look at jobs increasing now for 24 consecutive months, a very different picture. So you still have the number of job openings outpacing the number of unemployed in many sectors outside of tech. So tech for now is the exception to the rule. The question is that will that spill over to the broader economy? These layoffs in tech, and how much if these people can't find new jobs, how much will that start to impact the economy through spending and so forth. But in terms of the economics of these companies, this should help. It should help certainly with the bottom line. We're seeing more stability and in some cases rallies in these tech names. So the question is, if the economy goes into recession, is that going to put is that going to put further pressure on these companies to cut costs in the future? So something to watch for sure this year. Very different picture than where we were in 2020 and 2021 with these companies hiring. So in terms of that spending, in terms of that U.S. consumer, big question for this year is going to be, when will the U.S. consumer pull back? And I would say there's some evidence now that they are already starting to pull back. You just can't look at nominal sales to tell you that. If we look at nominal retail sales, they're up 5% over last year. That's a pretty good number in most economies in U.S. history. You would take 5% all day long. The difference today, of course, is we have over 6% inflation, and so if we adjust for that inflation, retail sales all of a sudden are negative. So when prices are rising at a rapid pace, you have to look at it on an inflation adjusted basis, because even if you sell the same amount of goods as last year, prices are the dollar number of those sales is going to go up just by the fact that prices have gone up. So you really have to adjust for inflation to see the effect on true demand. And now we're starting to see a few months here where we have negative year-over-year inflation adjusted sales. And the question for many is, why didn't this happen earlier? If we have 21 consecutive months where inflation was outpacing U.S. wages, why didn't we see this number really go down and go down more than it has and quicker than it has? And same thing with this number on the top. And the big answer all of last year that we pointed to was two factors. One being the savings rate going down to its second lowest level in history, 2.2%. So people are saving less, and they're also borrowing more. So the American consumer all of last year said, this is a tough situation, but we don't want to cut back just yet. We're going to save less. We're going to borrow more in order to maintain that level of spending. And the big question for 2023, of course, is how much longer can they do that? How much lower can the savings rate go? It doesn't seem like it can go much lower. How much more will they be willing and able to borrow to finance that spread? So, the question for 2023 is does the U.S. consumer hit a breaking point where they start to really pull back, and you start to see that in retail sales, and that's going to obviously drive earnings and economic growth if that were to happen. But for now, spending is not terrible, particularly in travel and leisure. We're seeing huge demand there, still outpace supply. This is a chart of U.S. airline travelers. It's now, if we look at the last 7 days, 8% above pre-pandemic levels. So that's the biggest spread to the upside that we've seen since the start of the pandemic, where you're seeing more travelers today actually than the same period in 2019. And this is in spite of the fact that prices have gone up significantly over that period of time. Anyone who's bought an airline ticket recently probably can see that it's up over last year, way up over a few years ago, and this is helping airlines. Profits of airlines. United Airlines, one company reported a 30% increase above pre-pandemic levels. So you just have the situation where the U.S. consumer had a lot of pent-up demand, particularly for travel. They didn't travel during those COVID years. And now they're going out and spending, and they're spending in spite of price increases. But they're not immune to interest rate rises. They're not immune to that last picture that we showed in terms of saving rates and credit levels. And at some point, that's likely to hit the consumer. The question is just when. But the weird thing about last year in particular was the fact that we didn't have a U.S. recession, but we had the official U.S. recession, I should say, but we had the consumer sentiment picture just collapsing and hit a record low last year. You had 8 straight months in this index below 60. The record before that was only 4 straight months during the 1980 recession, but just remarkable persistent negativity in terms of consumer sentiment. What's interesting, the last reading is actually starting to move up. So maybe the U.S. consumer, all of this negative sentiment, or a big portion of it, was due to that rising inflation rate. And now with the inflation rate seeming like it's coming down and unemployment rate is still pretty low, they're starting to feel better about things. So every cycle is different. If unemployment rate goes up, I would suspect this is not going to be a good picture for consumer sentiment. But for now, if the inflation picture keeps improving and the labor market holds up outside of tech, you could see these numbers continue to improve. And so perhaps we're going to push that out in terms of the retail sales picture. We'll see. That it was just one number, but interesting to see sentiment improving here with all the talk of a recession this year. I want to end with an interesting chart. This is I like to end with something positive, and I view this as a positive for America. The fact that we have all of different states that are run differently, have different policies, different job opportunities, different tax rates, different affordability, and that leads to just a significant migration from one state to another over time. And what we've seen in recent years is a huge shift from higher cost states in terms of taxes, like New York and California, out of those states and into lower cost states like Texas and Florida, especially in terms of taxes and affordability for housing. So it's an interesting couple of years, certainly for migration patterns, but I view this as a huge positive for the U.S. The fact that you can vote with your feet and go to the place, move if you don't like the situation you're in, or if there's a lack of job opportunity or taxes are too high, or any number of situations, you can move, and that'll drive policy in the future, right? So very important fact that not every area in the U.S. is the same. There's some place for everyone in terms of different policies, and these trends will shift certainly over time, but the trend in recent years, recent decades, has been out of higher cost states like New York and into lower cost states. And just a really interesting fact that I looked up in terms of New York's population, it's actually the same as it was 20 years ago, and Florida's population has increased 6 million over that period of time. Just a stunning shift in terms of the population of those two states. All right, so we're going to end it right there. Have a great week, everyone. Thanks for joining. As always, if you like the content, subscribe to the channel, and we'll see you next time. Thank you.